Good afternoon, everyone. I want to welcome you to today's Learn at Lunch webinar. We will hear from Extension Farm Tax Specialist J.C. Hobbs as he provides a tax update to our listeners. If you have questions, you may ask them through the chat window by clicking the chat button at the bottom of the screen. For more information on this and other farm management topics, visit the eFarm Management page. I will share this link in the chat window. Our next scheduled webinar is Keeping Better Financial Records, scheduled for February 4th at noon. JC, I will turn it over to you. And I see you on the screen right now, but not your slides.
Huh, Jet,
I see the slides.
Okay, well, maybe it's just me. Thank you.
have no idea, Brent. I'm going to keep you in the dark today.
Okay.
All right. So, as Brent asked me to do, and this is not really an update because here's why an update didn't work out for us. The president and Congress are still trying to figure out where we may end up with tax law changes for this year. I do expect some of them. But right now, there is not much discussion from DC. Excuse me. And when we know more, Brent and I will be presenting that in another one of these sessions. So, right now, what I'm going to talk about is some of the things that I've been hearing questions on since basically the first of the year. Questions concerning, all right, as I get to this time and looking at what I had from income last year, what can we do to manage that to minimize some of our tax liability? So we're going to present this more of a tax planning opportunity and kind of a tax management. What's really interesting, so when you look at agriculture, our producers have a wide variety of unique options for tax planning. When you look at the number of options and tools available, ag producers or farms and military and clergy have more specific tax rules than any other group. So if you look at businesses, farm businesses have a lot more options when we compare that to other businesses or Main Street businesses, etc. So we have a great number of tools in the toolbox. And a lot of times I'm not sure how many of those we really utilize. So what we're going to be talking about today is some of the things that I feel like we don't use enough of. And working with your tax professional, looking at these is very important. One of the things I put here at the bottom, no matter what you do, leave yourself some wiggle room because sometimes things just happen. And I expect some changes in the tax law before year end. And we may not want to lock everything in at this point in time, but we sure want to know what options we do have. Again, when we look at farm business and business management, we make decisions based upon improving profitability, not on the point of reducing taxes. So the topics we're going to hit upon this morning, we'll talk about the change in the special depreciation allowance. That's bonus depreciation. Now this has been changing for the last 4 years. The number's been declining. So we're going to present to you what they are for this year, for 2024 or 2025. We'll talk a little bit about 2026, and remember, it's supposed to expire in 2027. Will that happen? I don't know. But anyway, we're going to talk about it and kind of give you an idea of what might to expect here. The 179 the expensing deduction is also changing. That number was made permanent, or that the rules for 179 have been made permanent, but the amount that's allowed each year does change. And then the next topic is income averaging. Yeah, in our conversations with the IRS and the others, one of the comments that comes from the IRS is income averaging is a very unused tool. It's a very unique tool for farmers. Nobody else has this ability, but we have very few farmers and ranchers that use this, and it's a tool that can be used to reduce tax in the year or in a period when we have a large amount of income compared to prior years. Then we'll talk about a little bit about crop insurance proceeds and how the reporting there can impact us. And then again, when we look at the drought rules, Oklahoma, more than half or nearly 2/3 of the counties are back under drought situations for last year. Hasn't improved much. And we'll talk about some of the things that you might want to think about there, again, from a tax management point of view. So why do we need to be doing tax management? If you look at this chart, these are the 24 income tax rates for a married filing joint return. Now notice the blue line at the bottom, that's the 10% bracket, the 12% bracket, then we jump up to the 22% bracket. The dotted orange line is the self-employment tax. It's static at 15%, 15.3%, until we get up to income around 160 some thousand, almost 170,000 rather. Once we hit that point, the amount that applies for self-employment, the Social Security side of it goes away, but the Medicare side remains, and that's about 3.2%. So that's why that dotted line, the orange line goes down, but it's static no matter how much income you have beyond that point. The green line, dotted line, is when you add those two together. And notice what happens when you add those two together. The 10 and 15 end up at 25. So our taxable income, for the most part, farm income, is taxed at 25%. Then we hit to about 22 something, 22.8, I believe. And that number jumps up when we move to the 12% bracket. Then when we get to about 90,000, we jump into the next level, the 22%. So it becomes very important to manage our taxable income so that we stay somewhere below that 90 some thousand. So consequently, that keeps us in that 12% income tax bracket, keeps us in a situation where we're below the 25%. So we're staying closer to the 10 plus 15 or 12 plus the 15, around 22. So there's the reason we do the tax planning, tax management. We try to keep our income down to where we're paying as little as possible in terms of total tax. Now, when it comes to the rules, it's changing on us. The special depreciation, that's the bonus depreciation. For 2024, it was 60% of the cost of an asset that we could write off in the year it was purchased. That remaining 40% was treated or was allowed regular depreciation. So when we bought a new item in 2024, we got in excess of 60% of it written off in that year. For assets purchased during 2025, that number is going to be 40%, plus then what we add to from regular depreciation. 2026, unless Congress acts before year end, it will go down to 20. And in 2027, it goes away unless Congress does change that. Now, it does apply to new or used property. All it has to be done is purchased and placed into service during the tax year. So if we buy a new tractor in 25 or buy a new truck in 25, and we put it in service during that time, we get to write off 40% of that plus additional depreciation. So that's the bonus rules that we're seeing this year. So let's look at the numbers here. So you buy a $100,000 tractor. The amount of bonus depreciation allowed for 2024 was $60,000. That's 60% of that $100,000. Regular depreciation that would be allowed under makers is $8,000. That's the difference between the 100 and the 60, so roughly 40,000 and 20% of that. Now, total depreciation then allowed is 68,000. That's the 60,000 plus the 8 of regular depreciation. So you can see that we're not going to get the full 100,000 written off if we use bonus. So if we're really needing to get really tough on depreciation write-off to manage our taxes, we're going to want to do something else. So our next option is to use the 179 expense election. That's a deduction that allows us to write off up to $1,220,000 of assets purchased in 2024. It's going to go up to $1,250,000 for 2025. So that gives you a pretty sizable amount that can be written off to reduce our taxable income. Now, the next line that says there's a phase out threshold. Yes, once you get above $3 million in total investment in depreciable property, there's a phase down until it goes to zero. How many farms and ranches hit that? Not that many, but it has happened. There's another limitation that also applies. It's also limited to the amount of net farm income. So when we look at net farm income, we have to make sure that our excuse me, investment in that property is less than or equal to the amount of net farm income we have. So what does that mean? The last bullet shows that $100,000 tractor we bought. We can write off using expensing up to $100,000 if our net farm income is $100,000 or more. So we can effectively take our net farm income down to zero through the use of the expensing election. Now, is this wise? Maybe, maybe not. You probably want to talk to your tax advisor to see what else is going on there. So going a little further, $100,000 tractor purchase, we have $200,000. Expensing allowed is $100,000. Compare that to bonus of $68,000. There's a $32,000 difference. Therefore, depending upon where you're at in the tax or where your total taxable income is, and if you're needing to have net farm income great enough to allow us to have paying Social Security, that's the self-employment tax, to get either retirement benefits, disability benefits, or survivor benefits for our spouse, you may want to look at having some net farm income, so not using the full amount of the expensing, but using the bonus and kind of manipulating numbers. That's why this is here. Depending upon what we do, we can use depreciation, expensing, and bonus to modify our taxable income to maximize either our self-employment tax benefits or some other things that may be of benefit to us as well. So it's depreciation, a great tax planning tool if used correctly. Now, the rules with our bonus in Section 179, unless we elect out on the tax return, and your tax preparer knows what's going on here, unless we elect out of bonus, it's assumed that we're going to use it. If we don't elect out, we're going to use it to the point where it's maximized, and then regular makers depreciation is used unless we elect out and decide to use the 179 expensing election, because to use 179, you have to elect in. So you have to elect out of bonus and elect into 179. Now, tax planning, like I said, is going to be changing for the next couple of years. Work with your preparer, look at what's going on, get an idea of what your taxable income is going to be doing over the future. This gives us a better tool for planning using depreciation as that tool for managing taxes. So here's some of the other pieces. If you want to slow it down, elect out of bonus, don't use 179. We have the ability to spread it out even further using the regular maker's depreciation, which is a double declining balance. You can reduce it further. If we know what our income is going to be doing, we can take it down to 150. We can also use straight line. If our income is not expected to change much over the years, it might be wise to use straight line depreciation over an increased depreciable life. Just some things to think about. So here's what the depreciation methods look like over time. unless you, now this doesn't include bonus, this is just the depreciation makers. The 150%, the 200% straight line, and then the alternate depreciation system kind of gives you an idea how long we're spreading things out and how level things can be. So our next piece I want to talk about is income averaging. Sorry about my voice, but my sinuses have been having a heyday recently. So income averaging, it's a special election that's again allowed for farmers. It is also allowed for fishermen. Those are the only two business groups that can utilize this. And what it does, excuse me, it utilizes unfilled tax brackets in prior years. So if we're in the 22% bracket this year and we were in the 10 and 12% bracket in the 3 prior years, it's beneficial to move some of our excess income or income that pushes us up in that 22% bracket into those 3 prior years. So what we're looking at, selected farm income. So what we look at is the 2024 total amount of income that can be averaged. Then that amount that we decide that we don't want to be taxed in 2024, we spread that equally over the 3 prior base years, those being 21, 22, and 23. The overall tax is then recalculated and compared. It doesn't amend the prior year's returns. It just impacts the amount of tax we pay on the 2024 tax return. So it's just about the tax rates, and we're moving money so that we can get it in lower brackets in those base years and reduce the current year tax bite. So like I said, doesn't impact income subject to self-employment tax. And the elected farm income, this is the income that we can pick and choose from, and we can cherry pick that. We can use as much or as little as we wish to manage our total overall tax bite that occurs in 2024. So it's income reported on the Schedule F or the Form 4835, which is the farm rent from crop share. We can pick from gain that occurs from the sale of machinery or breeding livestock. There's certain farm pass-through income. So if we're in a partnership or an S Corp, we can move some of that around. It also include wages from a S corporation. If you're greater than 2% shareholder, we have very few farms, but I thought I'd put that number in there just in case you are farming with an S corporation. It has some benefits. The gain on sale of land is not eligible. So it's only farm income, machinery, pass-through income related to the farm. So here's how it works. Notice the amount of income we have in 2024. It's great. That line, the horizontal dark line in the middle of that red bar, that's the top of the 12% bracket. So if you look at 21, 22, and 23, we were below where that tax rate that we were applying was the 10 and 12% rates. So what our goal is to move that income that's up in the above that horizontal black line, what's in the 22% rate, move that equally to 21, 22, and 23. So if you're looking at how much that would be, this next slide gives you an idea. We're going to move $30,000 from that amount that's above the line there. So notice the 22%, we're going to move $30,000. We're going to put that $30,000 into the 21, 22, and 23 tax years. So if we left it in 2024, it's going to be taxed at the 22% rate. The tax on that is $6,600. If we use averaging, so we're going to move some of that to 2021, 2022, and 2023. The 10,000, one of those was a little high, so part of it's going to be taxed at the 22% rate. The other 2 years, it's going to be taxed at the 12% rate. The total tax on that is $4,600. So we're taking the amount that's taxed at the 22 is going to be $2,200 plus the 2,400 in the 20% brackets, 46. So if we do this correctly, in this example, very simple example, we saved $2,000. To me, that's significant. So again, income averaging, the reason I brought it up here, the IRS and a USDA study that was done in the early 2000s both indicate that this is not a very well used tool. It should be used more. There's a lot of individuals that could gain from this. And I'm not sure exactly why we don't use it unless it's just simply an understanding or not understanding how it works. Again, it's very beneficial. It's moving income from a high income year. We're going to tax it at the rates from those low income years. It doesn't change anything except the amount of tax due in 2024. So ideally, it's utilized in high income years. Now, income averaging, it maximized when that marginal tax rates for those base years equals the marginal tax rate of the election year. That's the current year, 2024. Does this always occur? No. But even when it doesn't occur, it does give us a great amount of benefit. What it also can do is sometimes create gaps for future years. Remember that 2024 amount was large. If we reduce some of that and move it to the prior 3 years, then if our income jumps up in 25, 26, or 27, even greater than what it was in 24, we created another gap that could be used. So income tax for each year is then used against future base years, which is calculated against an earlier election year. The election year in this example was 2024. So income averaging, like I said, it works. It makes sense. It's a wonder we don't use more of it. Now, the question I've been receiving real recently can also infers.
JC, can I ask you a question?
Yes, please do.
How frequently can you do that income averaging? Can you do that? Do you have to wait then 2 or 3 years to do it again? How does that work?
No, it can be used this year, next year, and the year after.
Okay.
It can if you look at the number of years that let's say that we're going to use it in 2024, we carry it back 3 years. If you look at the number of years that 2024 decision impacts, it's a total of 9. The current 4 plus 5 more in the future. So, yeah, we can use it as long as we need to.
Super.
It doesn't
Thank you.
go away. Okay, let's go back to our slide set here. Crop insurance. Those that received crop insurance proceeds this past year, and some of you have, probably quite a few have. If you take the crop insurance proceeds, and we normally sell that crop in part of it in the year that the crop was damaged and the following year, we end up kind of stacking the income in the year the destruction occurred. So what crop insurance deferrals allow us to do, if you normally sell more than 50% of the crop in the year after harvest, and the crop insurance proceeds are determined based on the harvest year, we can then move that amount that would normally be sold into the future year and take that crop insurance proceeds and do the same thing. So crop insurance proceeds can be moved then into a future year. And again, it allows us to avoid stacking the income. Now, it only applies to cash basis farmers. And if you look at the rules that say that, less than 2% of our farmers nationwide are accrual basis. So this applies to a large majority of our producers. And this is something, again, I'm not sure how often it's used, but it's for the crop damage. Our revenue policies, it doesn't work. So it has to be for crop damage, and it can't be from a rainfall or weather insurance policy. It has to be a true crop insurance policy. And you have to remember the revenue portion can't be moved forward because the revenue portion is figured the year after the damage occurs. So it's only the damage that's allowed to be moved. Again, a great tool if you normally sell your crops part in 1 year and part in the next, or you sell everything in the year after harvest. Now, the weather-related sales, we're back in this. And there's a county in Oklahoma, Ellis County, that's been under the gun of the drought rules for the last 19 years. The question that came up last year during our meeting with IRS is, are we setting a new norm for some of these counties to determine what drought is? I don't know the answer to that, but that is something that's being kind of discussed. But what weather-related livestock sales, it's an election when we sell more animals normally that would not normally be sold in a year because of lack of feed, lack of water, etc. So if our grazing is down because of the drought, and we have to sell more cows or more animals total than we normally sell in a typical year, we're allowed to make an election to move that income into another year. Now, the 451G rules, it applies to market animals as well as breeding stock. Again, applies only to sales in excess of normal. So if normally we sell 100 calves every year, but due to the drought, we end up selling 120, that 20 head is in excess of normal. We're allowed to move that income into the next year. It does require a federal disaster declaration. Right now, 54 counties in Oklahoma qualify, at least 54. I haven't looked in a while, but that's where the numbers were. And it defers recognition of income to the following tax year. So it simply, again, allows us to avoid stacking the income in 1 year when we would normally have sold those animals and spread the income over 2 years. The other one is the 1033E rules, and it only applies to breeding, dairy, and draft animals. Now, the reason I put those code sections in there, when you go talk to your tax preparer and you take this information to them, they can go find the rules for that. And I'm going to provide them some more information and provide you more information in a moment of all the details you need to know. But the 1033E rules, that's the breeding, dairy, and draft animal rules. Again, only applies to sales in excess of normal. It doesn't require a federal disaster declaration. All we have to have is proof that a drought did occur. So when those animals are sold, they're breeding animals, when they're sold, we take and basically hold that income off the tax return, and it is postponed until replacement animals are purchased and later sold. So what we're doing is we're taking the gain from the animals that were sold due to the drought. Any taxable gain that would be gained above their tax basis is then not reported on the tax return. It's simply moved forward, and that gain is used to buy replacements. And when we buy those replacements, we kick the can even further down the road, and we don't report the income until those animals are sold. So we could postpone this reporting of this extra income for quite a few years. I worked with a farmer the other day, and we actually found out that he'd postponed this thing about 11 years. He bought some nice replacement heifers, and he kept the majority of them for that time span. So we can kick the can down the road for a long period of time. So when the replacement animals are purchased, that basis is those animals, and it decreases that deferred gain. Consequently, again, we avoid paying tax. Here's the information that you would need to take to your accountant. There's 2 releases. There's an information report, comes from the IRS. It's released every September. Then there's a notice that comes out shortly thereafter, and it lists all the counties. There was 58 Oklahoma counties in that notice. And then there's another notice that came out in 2006 that had detailed instructions plus examples of how to apply the weather-related sale rules to a taxpayer. So if somebody comes in your office, or you need to take this to your tax preparer, those are the 3 items that they need to look at to properly make the election and then properly report the income under those 2 different tax rules. So, additional thoughts? Be sure to talk to your tax advisor, evaluate the impact of these tools. In the long run, what we're wanting to do is look at net farm income plus non-farm income being greater than our family living expenses plus our tax liability plus any land principal payments or other principal payments that we make. When we look at it that way, that means we're in the black, we're doing well, not sliding backwards. So with that, questions and comments. Here's a webinar survey link that Brent would like you to fill out. Let's open it up for questions. I think I'll see a few here. We answered the first one. We answered the second one. How long can you use income averaging? Pretty much forever. Anything else we need to talk about? If you have questions, please email me. That's the best way to catch me. jc.hobbs@okstate.edu. If you have a detailed question, need more explanation of what you can send over an email, there's my phone number. Give me a call. I respond to those as quick as I possibly can. So with that, Brent, I guess we're leaving it up pretty close to on time.
We sure are. Thank you again, JC, for presenting today. We do appreciate everyone letting us know how the webinar went by filling out that short survey. And I also shared a link to the survey in the chat window for everyone to click on. We hope we will see everyone again for our next Learn at Lunch webinar on Tuesday, February 4th at noon to learn more about keeping better financial records. And so I don't see any other questions, so I'm going to go ahead and end the meeting today. So thank you everyone for joining us, and we'll see you on February 4th.
Thanks for inviting me, Brent. I appreciate it.
You're very welcome.